Our group of Denise, Johanna, and Kayla decided to do our presentation on the company of Enron, which was an American energy, commodities, and service company that fell in the early 2000s. Enron was founded in 1985 and it is based in Houston, Texas. And it started as a merger between two companies, InterNorth and Houston Natural Gas. Initially, the company was named HNG/InterNorth Incorporated, but after some debate from the higher ups, they decided on the name Enron. In the beginning, the CEO for the merged company was originally the CEO from InterNorth, Sam Signar, but he was fired shortly after the merger by the board of directors, and the CEO from Houston Natural Gas, Kenneth Lay, became the CEO of the company. In 1989, a man named Jeffrey Skilling, who was a consultant for McKinsey & Company, had the idea to link natural gas to consumers in different ways, and this led Enron to form what was called the Gas Bank, which allowed producers and wholesale buyers to purchase Enron's gas supplies and effectively turning natural gas into a commodity. And in 1991, he actually joined Enron's team as head of the Gas Bank. From about 1991 to the 2000s, Enron made a gradual transition of a focus from just a producer of energy and began to act more like an investment firm and sometimes even a hedge fund. And they were making profits off of the margins of the products it traded. With the Energy Policy Act of 1992, this allowed states to deregulate their electricity utilities, allowing them to be open for competition. And so Enron was able in 1994 to enter states such as California, Ohio, and Iowa. As the fiber optic technology boomed in the 1990s, Enron sought to keep its costs low, so they wanted to own their own personal network. And in 1997, Enron constructed a 1,380-mile fiber optic network between Portland and Las Vegas. Enron wanted to trade bandwidth like it traded oil, gas, and electricity, and they essentially wanted to own the internet. And they sought to have all U.S. internet service providers rely on their Nevada facility to supply bandwidth. This is some of Enron's history up until the scandal that led them to fall, which Denise will talk about next.
The key players are Ken Lay,
This is an overview of the org chart of Enron. You can see we have Ken Lay and Jeff Skilling at the top, followed by Chief Financial Officer Andy Fastow and Cliff Baxter on the right, the Chief Strategy Officer. You can see it's pretty standard org structure for a really large company, but it gets very complicated just because there's so many different services. If you look down below, there's energy transportation services, wholesale services, energy services, which Lou Pai was in, and those energy services are also what caused the rolling blackouts in California. Under Enron Broadband Services, that's where the whistleblower Sharon Watkins would have been stationed in her accounting position. Enron itself is a business. It's a profit maximizing business. The investing culture of the 1990s saw huge gains in the stock market, and this general culture saw high values in dot-com stocks and huge gains in the energy sector stocks. This new boom was assumed to become the new norm in investing. So a majority of investment advisors would view Enron's financial statements as an incredible growth opportunity and would often advise their clients to invest in Enron to take advantage of growth. Now, the tone at the top of Enron was that we are a cutting-edge company. We are completely ethical. That was Ken Lay's song and dance all the way through his trial. He was completely ethical, yet he was not an accountant, so he could not explain his accounting records. Inward, however, the corporate culture was very competitive. There was competitive towards having absolute profit maximization. In addition, Enron being so cutting edge, they wanted to capitalize on the frontier of broadband and start shifting their focus from physical assets to, Sharon Watkins called it commoditizing new frontiers. So they tried to commoditize broadband and also commoditize the energy sector in California, or the electric grid in California. And in California, they were trying to buy and sell the electricity on the open market due to deregulation of the California energy market. Enron had built up so many business ventures. They were such an international company, but specifically there were two examples of their wrongdoings within the United States. One of them was the Blockbuster fail, where Enron had an attempt at commoditizing broadband, but it seemed to be premature as far as the market today versus back in 2000. They had a notable failure with Blockbuster, and this was a very publicized deal. Enron utilized mark-to-market accounting to book the future gains before they were actually realized. So in this failed deal, Enron booked the potential gains from their Blockbuster deal on their books, even though the deal failed and never went through. In summer of 2000, rolling blackouts happened all across California. California had recently deregulated their energy grid, making electricity a commodity that could be bought and sold on the open market. Enron took advantage of this new market and hired traders to buy and sell this electricity. Now, this created an artificially high market because the traders could buy and sell based on the price of electricity to maximize their own profits. Later on, the market manipulation was investigated by the SEC and the Federal Energy Regulation Commission. This is the best example that I could find to show how intricate Enron was set up as a business. And then to show, if you look down below, the T-Bird LP, Raptor LP, Pelican Bidder LP, that second to last line, those are all special purposed entities that were set up to hide losses in Enron, and they would have been set up not only by Enron's accountants, but also by the help of Arthur Andersen's accountants. And if you just look at this web, it is pretty amazing and complicated. In addition to the web of organization structure and creation of special purpose entities that Enron held, they also had a web of interrelationships with a number of banks and companies, the government, throughout the US and internationally. Most specifically, paying off Arthur Andersen bought them a stamp of approval, paying off Vincent and Elkins, their attorneys, bought them law insight, interrelationships with the traders at Chase Morgan and Citibank, bought them complacency from market professionals who otherwise would have examined the balance sheets and income statements of Enron more closely, but they were all making so much money. Why would they ask any questions? Additionally, with the government, Ken Lay had dealings with the Bush family, had dealings with in California with electing Arnold Schwarzenegger. It really is a huge web of interrelationships that Enron has created. I just wanted to revisit a little bit of Arthur Andersen's role working with Enron. Arthur Andersen was paid $52 million in fees by Enron just to stay on the books. They definitely worked with Enron's accounting department to help set up these special purpose entities and to make sure that losses were being moved over to SPEs in order to keep the statements of Enron looking viable and looking like they were making all of the money possible. In addition, Arthur Andersen was in the top 5 accounting firms in the country, so they were considered a reputable auditor. And Enron basically paid off Arthur Andersen and bought their stamp of approval. On August 15, 2001, Sharon Watkins, who was the Vice President of Corporate Development at Enron, she wrote an anonymous letter to Ken Lay, and she wrote that she was really concerned about the accounting practices within Enron. She said there were many irregularities in the financial reports. Later on, she met with Ken Lay in his office, and the next day she was demoted from one of the upper levels where the CEO would have been down to the 12th floor is what she said in an interview. Later on, she testified at congressional hearings, sat next to Ken Lay, and as he repeatedly said, "I am not an accountant. I cannot testify to these numbers. I cannot explain them." Sharon is now speaking out towards ethics and in accountancy. An interview with Sharon Watkins she explained the frog in water analogy. Whereas if you're working in Enron, there was such a tone throughout the company that everything was okay. So in her analogy, she said that if you have a frog sitting in cold water and you slowly add on warm water over time, you're eventually going to cook the frog. And that's how she likened her position in Enron, and also the general complacency within the company amongst all the employees, or majority of the employees, to the accounting fraud that was going on. I thought this graph was very interesting. You can see the timeline as Enron starts crumbling, and you can see their very prized stock price really tank. Specifically in 10 when Skilling has an outburst, and 11 when he resigns, and Ken Lay has to take on the CEO position again. And that's the point where the whistleblower Sharon Watkins would have sent a note to Ken Lay about the accounting inaccuracies. This is the jury's decision on how many counts of fraud that Ken Lay and Jeff Skilling were convicted of. They were charged with conspiracy to commit securities and wire fraud, securities fraud, wire fraud, securities fraud, false statements to auditors, insider trading, bank fraud, and other false statements. And this is just gut-wrenching to see how embedded their dealings were essentially throughout the American economy, not just through Enron, but all the way through the economy, especially with the securities trading.
Enron, the seventh largest corporation in the U.S., valued at one point over $70 billion, was being audited and consulted by Arthur Andersen, one of the nation's oldest and top 5 accounting firms, being paid up to $1 million per week in the year 2001 by Enron for consulting fees, making Enron one of Arthur Andersen's largest clients. Enron adopted mark-to-market accounting. This allowed Enron to report profits on their statements as deals were signed rather than as profits were actually made. This allowed Enron to report whatever they wanted their profits to reflect, like the diagram above. 2 plus 2, according to Enron, was 178. Enron's accounting method later on attributed to Enron's accounting fraud. As of 1997, Enron started losing money and accumulating debt due to this accounting method. Instead of admitting to these mistakes and making changes, Enron began using accounting tricks to hide their losses and avoid a decline on their stock prices. Enron created SPEs, special purpose entities. They were used to hide the company losses, utilizing off-balance sheet financials, making investors unaware of the massive debt they had incurred. Enron continued cooking its books to show what they wanted their prices to be. Tipping canoe, technical training, being proficient on your industry, independence, acting with integrity, being unbiased, acting with due professional care, practicing professional skepticism and being skilled, planning and supervision, being supervised, ensure everything's planned out, internal controls, the reliance on their systems, corroborative evidence or sufficient appropriate evidence being collected, accordance with GAAP, explicit on your reports, no new principles, being consistent, omitting disclosures, expressing opinions as a whole in its entirety. Each one of those standards were overlooked by Arthur Andersen. According to court documents, Enron and Arthur Andersen had improperly categorized hundreds of millions of dollars, misrepresenting the true value of the corporation. Arthur Andersen did not follow GAAP. Enron's audit committee failed to follow up on high-risk accounting issues, for one. The one person under Merrill Lynch was fired as being the only person to threaten the reliability of Enron stock. And Enron later merits the bank with contracts of over $50 million. This was pressure on Arthur Andersen to ignore the accounting practices to ensure the stock prices remained. These standards exist for a reason, to avoid the business suicide that Enron created as well as Arthur Andersen created. Had any of the standards been abided by, it could have avoided such a massive bankruptcy for both companies. Arthur Andersen later on fires the person in charge of auditing Enron's corporation after they have learned that he had ordered the destruction of thousands of documents and email messages after being aware that the Securities Exchange Commission had begun an investigation of Enron's accounting. Arthur Andersen was found guilty on federal charges of obstruction of justice by destroying thousands of documents related to Enron's accounting practices.
The scandal of Enron affected a lot of things in accounting, business, and for investors. Now that Enron had to let go a lot of their employees, there was a mass amount of accountants, auditors, and CPAs that flooded the unemployment market. A lot of them joined the other big firms. Some created their own accounting firm, and some of them just left accounting altogether. Also, what was created out of the Enron scandal was the PCAOB, and this board was created because before, the development of auditing standards and oversight of auditing firms were self-regulatory responsibilities of the U.S. accounting profession. So now someone actually looked over that. For the business side, the Sarbanes-Oxley Act of 2002 was created, and some of the key sections in that act were Section 302 and 404. 302 was a mandate that requires senior management to certify the accuracy of the reported financial statements, and Section 404 was a requirement that management and auditors establish internal controls and reporting methods on the adequacy of those controls. With the scandal for investors, they just completely lost faith in the American economy. And because of that, I mean, a lot of people, investors, they lost about $60 billion within a few days because of the Enron scandal, and they lost their old age security, which was a big deal. So that was pretty important, and some of the main reasons that so many things have changed today in accounting, business, and just for investors in general because of the Enron scandal.